with today's topic, Ambit TenX portfolio. Promising a journey which is exciting, promising a journey which will be enriching, promising a journey which is fulfilling. When we launched this product, and this is the fourth product in our basket, so everybody knows that we run 3 funds already before Ambit TenX portfolio. We launched our oldest fund, Ambit Good and Clean Midcap Fund, which was launched in March of 2015. And then the second fund, Ambit Coffee Can Portfolio, in March, April of 2017. Then came the third one, Ambit Emerging Giants Small Cap Portfolio, which was launched on 1st of December 2017. Then we decided that Ambit TenX portfolio, it's a brilliant opportunity because India is changing, so is the market dynamics, and so is the marketplace. Can we benefit out of it? And that's when Ambit TenX portfolio came into existence. When we launched the portfolio, the underlying thesis was, is, and remains the same. Ambit is saying that India's economy should hit a $10 trillion mark by 2033 to 34, which means in a decade's time, or little more than a decade's time, India will be the third largest economy. But the problem is, the future is uncertain, the future is unknown, and the future is unpredictable. How do we solve it? We always, as we do, we look at the character of the country. We look at the character of the individuals, and the same way, we look at the character of the country. If we see that the past has been promising, there is a probability, there's a finite probability, there is a huge probability that the future also is going to be very, very bright. And that's where we are very, very confident. And in next couple of slides, what I'm going to try and show you the character of India, how India has transformed in midst of a chaos, in midst of an uncertainty, in midst of a challenging situation. We have currently 2 wars going on in the world parallelly. One, a Syrian war since 2014, and one, a Russian war, Russian-Ukrainian war. And there is a third one which is knocking at the door, the China-Taiwan conflict. Despite of that, India remains resilient, India remains strong, India remains buoyant. Is it by chance? Let's look at some data points. Let's look at some very, very interesting data points. So in last decade or so, the labor productivity in India has actually jumped from $15,000 in purchasing power parity terms to nearly $21,000. What we see from here is nearly 9 crore jobs being created in the non-farm segment, which is predominantly services and manufacturing. And these 9 crore jobs is definitely going to bring down the contribution of the workforce or the people involved in the workforce in relation to the farm or agriculture dramatically from 42% to a relatively smaller number. What does this encompass? It means that India is not only thriving in terms of services, but also in terms of manufacturing. We have already seen that in last few years from nowhere, or just a decade back, India was nowhere in the mobile phone manufacturing business. Today, India is the second largest mobile phone manufacturer in the world. In terms of two-wheelers, India remains the largest manufacturer. So what India is focusing on, recently there was a very interesting article which came in which said that Apple iPhone 14 is going to get manufactured in India in next couple of months, shifting its base from China. So what we are seeing is make in India, make for India, and make for the world. Make in India, make for India, and make for the world. If you look at some of the past data, the per capita income, we are the fastest growing economy, not only in the GDP terms, but also in the population. Our population is rising, and ladies and gentlemen, our population is rising very, very fast. So also the numerator, but the denominator is also rising. Despite of that, the purchasing power parity has nearly doubled in a last decade, from $4,800 to a $7,300, $7,220 to be specific. And this trend continues. But what has been very, very remarkable is the financial inclusion. Everybody knows about demonetization, Jan Dhan. Lots of policies which came in to ensure that the last man standing also participates into the growth of the country, not only through his wages, but also financially. We already know how the FIIs have been tipped down by the domestic buying. And thanks to all the investors, intelligent investors like yourself, because when the markets tank, you have been buying. Earlier, what used to happen before 2018, before 2017, when the markets used to tank, the domestic institutions, the domestic people, the people constantly used to sell. Just some statistics there. Till about June, FI sold in India closer to $33 billion worth of equities. The Nifty corrected back closer to 14.5% on a calendar basis. Rewind backward, 2008, dollar terms. I'm using the dollar because there is no ambiguity in terms of the rupee. 2008, FI sold $24 billion and Nifty was down 52%. That's the power of domestic buying, because this time when FIs were selling, domestic institutions were grabbing. That's the opportunity, ladies and gentlemen, which India presents to you, because today the Indians have realized the power of India, which was unprecedented. Earlier, India was not supposed to be safe. Today, it is the heaven. There is no chaos in India. Across the world, across the Western region, there is chaos. There's humongous amount of chaos. We are seeing that the financial inclusion has jumped. Bank accounts have jumped from 26% to almost 80%. 80% in terms of penetration. That's the power. And what it will do, it will dramatically lower down. The cost of financing, because all the money which was stashed in the buckets, in the jars, under the bed, is all coming to the banking channel. When this sums, large quantum mammoths, gigantic quantums of money has come into the financial sector, automatically the access to capital also has democratized. Earlier, before 1991, only few hands controlled all the entire money. Then came 2017 demonetization, 2016. After 2016 demonetization, money found its way into the financial system. And post that, what we are seeing is that easy accessibility. Technology has played a very, very vital role in making sure that there is easy accessibility to the capital. And that has reduced the cost to a very, very large extent, which means increasing the profitability for the corporate India and increasing the disposable income and the pressure, easing of the pressure from the households. If we look at the forex levels, the forex levels remains robust. Forex levels remains nearly 100%, over 100% jump since 2012 numbers. In a decade, our forex reserve actually went up to 640, 630 billion. Now they are at 550, 560 billion dollars. Despite of that, it is 100% jump in a decade. The most interesting part, ladies and gentlemen, we still compare ourselves with China, and this is one data point which will show that how in times to come, India is going to tip down China as well. We are already seeing, as I mentioned, Apple, lot of manufacturing companies moving out of China, and the reason why they are moving out is simple. The companies in US, the companies in Europe who are manufacturing in China, they are worried that their technology will be stolen. Is it by chance that some of the Chinese mobile phone with the same technology as Apple is available at half the price? Any guesses from where the technology came through? I don't know. But interestingly, what we saw is the growth in FDI. Is closer to 9.5% on a compounding basis from 13 till about 22, whilst the FDI growth or the FDI inflow in China has been barely 5.5%, which clearly shows that in last decade, slowly and steadily, people are getting intelligent and they want to go to the largest, not only manufacturing hub, which India is going to eventually become, but they want to tap the largest market in the world. Make in India, make for India. That's the mantra which continues with the foreigners who are coming to India in a big way. The credit cycle, thanks to COVID, or I should rather say, after demonetization, first demonetization, then GST implementation, then the ILFS fiasco, and then the COVID taught something very, very interesting to the corporate world and to the BFSI segment. What it was is understand prudence, understand that in India, to raise assets, which means to give loans, is rather easier. One needs to manage the balance sheet side of the liabilities. What does that mean? Which means that you have to manage your financing part. The post-COVID regime shows that India on a constant basis has been deleveraging. So the interest coverage ratio is one of the highest in a decade. The corporate India is most deleveraged, and the benefit is all accruing in the economy as well as on the growth in the stock markets. The interest rate tax cuts which came in September of 2019 gave a fillip. India becomes one of the most competitive nations in terms of taxation, corporate taxation, and that's what is propelling. India today is the house for third largest unicorns. The largest still remains with the United States of America, closer to 850 plus unicorns, China with 300 plus, and India approximately at 110. There was a point in time when India was struggling with 5, 7, 10 unicorns. Now, practically you are seeing every week, every 2 weeks, one unicorn being born in India. And that's the entrepreneurial journey of the startup India, which has taken off. Other statistics, there are only 3% companies which actually from a small cap or companies from a 500 and below make it to the mid cap or the largest mid cap. The rest of them remain small cap. And how do you expect them to make money? Hence, although India is a great phenomenal story where every business, if done with right acumen, if done with right perspective, and done with reasonable smartness, breaks even at an operating level in merely 3 years, breaks even at a PAT level in 1700 plus days, 5 years. Yet lot of businesses die eventually. Lot of businesses get into the NCALT, losing the precious net worth of their investors. So India is all about a story of protecting, preserving and ensuring that you don't invest your money with unscrupulous challenges, unscrupulous people. People, when I say, it means businesses. Hence, identify the good businesses, people which are ethical, people which have high integrity, people which are good, which are clean, which have consistency, which is there. Invest, and you are certainly gonna make money in a country like India. So what is that thesis? The thesis which we run is Ambit TenX portfolio. Now, what is this Ambit TenX portfolio? The first thing we believe is that the key for any business to constantly keep growing, the first is that you need to have clean accounting practices. Since Ambit has a background, has a pedigree of being the chartered accountants earlier in their avatar, hence we know best about forensic accounting. Hence we know who's cooking the books of accounts. We know where the challenges lie, and we try and avoid those mistakes. It's been very interesting that in last 48 months, there are 22 businesses which have lost more than 90% market cap. We all know all of them. I'm not going to talk about them, but we all know businesses which have lost 90% or more market share or market capitalization. Ambit didn't even look at them because their initial screening process didn't allow them to appear. So that's the cleanliness of books of accounts. Conservative capital allocation. What does this mean? Very, very simple. It means focused capital allocation. Remember, ladies and gentlemen, there are only two things which are limited in this world: the human bandwidth and capital. We all are. You guys are wanting to grow your capital. We guys are wanting to grow your capital. Everybody on this planet is working for capital. And if you're working for capital, then you have to be very focused where you're putting your hard-earned capital. Because if you do not take interest in putting your hard-earned capital at the right place, you will be the one who will suffer. Hence, Ambit as a philosophy generally does not invest in conglomerates. Why? Very, very simple. When your left hand will pain, your right hand will get raised and will try and ease it out. That's what happens. That's what happens when there is wrong capital allocation, when there is a conglomerate. And hence, Ambit is very, very conservative in terms of capital allocation. We also ensure that there's no debt on the balance sheet. So what generally we try and do is pick up businesses which have zero debt to equity. We have generally pick up businesses which have zero debt to equity. No political connectivity, no political linkages, no crony capitalism. That's what we try and do. What is the investment process of 10x portfolio? Very, very simple. Businesses which are more than 500 crores in market cap, which filter the good and clean framework and which have almost negligible amount of debt to equity, and a bottom-up approach. Ensure that there is a basket of mid, small, and large cap. It's a flexi cap portfolio with a mid and small cap bias, where we can have up to 20 to 25% in large cap, 40 to 45% into mid cap, 40 to 45% into small cap. So it's going to be a flexi cap portfolio, and where there is a massive jump on the earnings. So what are we saying? And an average churn of 3-4 stocks in a year, 3-4 exits in a year, 3-4 entries in a year. What does this simply mean? It simply means, I'm giving you a nutshell. This is a entire 9-yard. I'm not going to talk the whole thing about it. What are we saying? We are saying we don't know about the stock price. If you ask me what is the returns, I don't know. What I know for sure is that in next between 8 years to 12 years, the blended EPS of the portfolio, should jump between 8 times to 10 times. That's all we say. I can choose the businesses very quickly where we have earnings growth. I don't literally care about the stock price. Stock price eventually will follow. But what I'm married to is the earnings growth. And that's what we are focusing on. And remember, ladies and gentlemen, it does not mean, some people may get confused. Some people may get confused that if I hold the same stock for 10 years, 12 years, I can do that. I can do that. I have a stock in our mid-cap portfolio, which has been there since inception. We have a few stocks, not a stock, few stocks which have been in existence since 2015 March. We continue to hold. In our coffee can, we continue to hold some of the businesses which are continuing to grow since 2017 March, April. The idea is not to be rigid, but nimble-footed. Be flexible. Wherever the growth is not coming, growth in terms of earnings, not the stock price, ladies and gentlemen. I'm repeating this multiple times so that there is clarity. We are married to earnings. So what we are saying, if the earnings of the businesses are not coming for 4-5 quarters, we will evaluate, we will shove it off, we will push it out, we will remove it, and we will bring the next horse, next big runner. So what are we saying? In next 8 to 12 years, the EPS growth, the earnings growth of this portfolio should grow between 8 to 10 times. That's the whole point. These are the businesses which have high ROEs. These are unlevered businesses. Despite of that, their ROEs will range between 15% to 25%. High ROE business, it's almost negligible debt to equity, growth potential phenomenal, and reasonable valuation of quality businesses. That's what is the key. We will generally enter into market, which is where we are the market leaders or market challenger. We will try and not enter into the 5th, 7th, or the 8th business. Now, this is the interesting part. What are we trying to say? So in a very nutshell, if I have to explain in 10x, what are we trying to solve is five problems. This is a futuristic business where it is enabled by technology. Now, technology can come into 5 parts. The one, it can be Internet of Things. It can be SaaS, software as a service. It can be platform businesses. But remember, guys, we don't enter into loss-making businesses. You know the good part, right? We don't enter into loss-making businesses. We don't enter into businesses which don't have pedigree and history. So don't worry about that. Platform businesses, that's the 3rd thing. 4th, where AI, artificial intelligence, AR, VR forms the critical component for the industry to grow. Let me give you a very, very simple example. Very simple example. There's a shampoo brand which revolutionized the rural markets just 40 years back. 40 years back, ladies and gentlemen, India has, by the way, over 280,000 villages. At that point in time, almost 95%, 97% of the sales used to come for shampoo soap only from the urban market, semi-urban market. Then there was a company by the name Kevin Care, which came out with a chick shampoo, a sachet of 1 rupee. Bingo. That changed the entire outlook of the shampoos market. Today, 60% of the sales of shampoos come from the rural markets. You have Heads and Shoulders, which is a premium brand of 5 rupees sold in nearly 2 lakh plus villages across India. That's the penetration. Another very simple example. All of you were witness to COVID. Just look at your households. Before COVID, 2018, 2019, how many laptops, official personal does not matter. How many laptops? I'm not talking about the smartphones. I'm not talking about the tablets. I'm talking about the plain laptops, a board with a key. How many laptops used to exist in any household? 2 at best. Today, every household is at least 6 laptops, personal, professional. I don't care. That's the penetration. So we are looking at businesses which are under-penetrated at the moment. And as India urbanizes, as disruptions will happen, these are the businesses which are going to get immense benefit out of the disruption. That's what we are trying to say in the 10x portfolio. Last, where technology forms the backbone of the company. We own a very beautiful, interesting company. We own a very beautiful, interesting company in the micro housing finance, where nearly 80 people are only employed, not for collections, not for sales, not for distribution, not for admin, but only on AI. What do they do? What do they do? Their job is very, very simple. Their job is to predict when is the next default gonna happen. They are looking at the customer trends, they are looking at the customer behavior, they are trying to predict when the account is gonna turn NPA, when the guy is gonna default. So technology forming a backbone, because we believe technology has revolutionized this world, and people who do not embrace, they will not be able to enter the next decade. They will survive in this decade, but they will not be able to enter in the next decade. They will cease to exist. Hence, technology is the key, and businesses who look brick and mortar, but who have a very robust technology platform at the back end, they are going to be the winners. And that's what we are trying to solve through these 5 technology interventions in the 10x portfolio. This is some interesting data. It's beyond imagination. It's beyond imagination that some of the numbers which you are seeing. Last 3 years, PAT CAGR has been approximately 30%. 30%, ladies and gentlemen, which essentially means it makes more than the compounding in 3 years is more than, if I take the absolute number, is more than 100, which means the PAT is growing nearly in 3 years. 3 years. ROEs, high ROEs. I mentioned about 16, 17, going up to 25. These are the unlevered businesses with the ROEs of 19-20%. That's the beauty. That's the beauty. And it is expected to remain so for FY24 and 25. Because remember, we are on a high speed zone in terms of earnings. We are only picking up businesses which have immense potential. What have we delivered? What have we delivered? You can see for yourself. What have we delivered? Very, very simple. This is the past performance, this is just the past performance. So I'm not going to talk about it, although it looks very, very beautiful. It has outperformed the indices by and large every time, but this is the past performance of not of the fund. This is the back tested data. Let me just be very, very clear and explicit about it. This is the back tested data, not the current data. And it has performed beautifully well. But this is what it stands out. FIs love this businesses. We saw this businesses grew in last 1 month when FIs came back by 12.5%, and since inception. Remember, we have a very interesting history. I must share this with you. We launched our all our funds, and then apart from and all the funds have been wrong, have a very, very wrong timing. We launched our first fund 2015, and bingo, the yuan crisis happened. We launched our second fund on the back of demonetization. The third fund, mid and small cap, formed its peak and started to fall from January 14th, 2018 onwards. And we launched this fund, and we all know Russia and Ukraine conflict started. So we have been wrong with the timing of the funds, but we believe that the strength of the business lies when the tough times are presented to them. And that's the same way human character is tested, and that's the same way business character is also tested. So that's the simple journey. That's a simple journey which the 10x follows. And I'm very, very confident that you don't have to worry about the stock price as long as you are allowing us to go through 2 investment cycles. So generally we say our investment horizon is for 3 years, 4 years. People say we want people to invest with us for at least 6 years. Why not 10 years? Thank you. You should invest for 10 years, but minimum of 6 years. Why 6 years? The reason being for 6 years, we will be able to see at least 2 business cycles. When we'll be able to see 2 business cycles, generally mid and small cap give excellent returns when you go through 2 business cycles rather than just mere 1. Are we also saying, since this is a fund, this is also a fund which will be there for with a perspective of a decade? Hence, we have created process, because what we believe, you all believe that only strong portfolio manager delivers. But the challenge is very, very simple. The portfolio manager, any large, big, small fund manager, big fund manager, everyone comes with their bias. The journey of a fund manager starts from an analyst. If the analyst has done lots of work into a particular sector, then he grows, and he grows, and he grows, and he always is biased towards the sector. And hence, to remove the biases, to remove the risk, process is the key. Process is the key for achieving scale. And it's a very, very simple correlation. Good people, strong people create strong processes. Strong processes create growth. Growth creates market capitalization. That's it. That's it from our end.